COP26 is the newest development in a long-term trend towards environmental sustainability and ESG more generally. It creates a new agency to synchronize sustainability disclosure standards worldwide, and the Glasgow Financial Alliance raised $130 trillion in private capital finance sector commitments for the transition to net zero over the next 3 decades. We can only expect COP27 and beyond to go even further. In contrast, the fast fashion industry is often maligned for the waste generated by its large production volumes. Certainly, these production processes yield high returns at large scales. Shein's revenue was estimated in excess of $1 billion in 2020 and expected to have soared during the pandemic. Yet Shein must also adapt to heightened attention by regulators and capital markets towards ESG. For instance, the newly created International Sustainability Standards Board aims to harmonize standards for sustainable investment. Meanwhile, ESG investment grew 6-fold from 2016 to 2020, and total assets are expected to hit $53 trillion by 2025. 1 in 3 of the largest public companies in the G20 already has a net zero target. The same regulatory trend is apparent across various jurisdictions, from the EU to the UK to China, just to name a few.
The fast fashion industry is also collectively moving towards more sustainable initiatives. This is due to the demands of younger consumers and difficulties arising from financing options. Shein's main competitors, such as H&M and Zara, have taken steps to be more sustainable. One such step is the pivot towards a circular supply chain, in line with the Material Sustainability Index. This increase in sustainability commitments has led competitors to turn to debt capital markets. For instance, H&M recently issued a €500 million offering of sustainability-linked bonds tied to specific KPIs over an 8.5-year period. This new type of financing would enable these companies to further fund their investment into cost-efficient, sustainable options and show the market their commitment to ESG.
Fund managers exercise discretion in setting their own ESG requirements, with the baseline being that of the UNPRI. However, since ESG considerations are becoming market practice, it is anticipated that limited partners may demand more prescriptive ESG commitments through specific disclosure agreements with fund managers. Following COP26, Shein runs the risk of being overlooked by private funds which increasingly favor companies that balance the ESG metrics of their portfolio. In light of further provisions being added to fund regulations, we anticipate greater obstacles with respect to fundraising capabilities, both within private and public funds, should Shein launch an IPO. Various regulators have already indicated supervisory expectations for financial institutions to incorporate sustainable finance risks during stress testing in anticipation of changes to capital requirements. Failure to meet these ESG requirements is likely to exclude Shein from public funds, decreasing demand for its equities and inhibiting the fundraising capabilities of an IPO.
This is immediately relevant to Shein. Since the company's equity financing may be inhibited, it will likely turn to debt financing in the form of bonds to finance activities such as its rumored acquisition of Topshop. The cost of debt for bonds can be derived from the coupon rate. If the demand for Shein's bonds weakens because of anticipated legislative changes, it will have to increase its coupon rate to make its bonds more attractive. The high coupon rate makes for more expensive debt, as Shein is required to pay out more money annually. One cautionary example is the oil company Ithaca, which saw an underwhelming response to their bond issuances last year despite a high coupon rate and good near-term fundamentals. In view of the macro trends towards green legislation, as exemplified by COP26, it's in Shein's best interest to take initiative to reduce potential obstructions to debt financing.
In conclusion, the general trajectory towards stricter sustainability standards is apparent, and we expect this trend to accelerate into the future. If Shein wants to maximize its debt and equity financing capabilities, it must be prepared to disclose these metrics either publicly or through confidential disclosure agreements with funds.
The question is Shein prepared for this impending future? The time to act is now.